I want a quick video on turnkey rentals and getting into the kind of the starter investments. If you're already an accredited investor or make multiple six figures or you're just too busy for this stuff, I would probably skip over to the syndication LP content that we have. Check out that page at thewealthelevator.com/syndication. But why rental properties in the first place, right? And again, we don't teach strategies of no money down, wholesaling, which a lot of that predicates on you spending a whole bunch of energy, maybe even a lot of cost for these yellow letter mailers to go out and find people who are down on their luck, maybe divorced, going through despair, maybe they had death in the family, where you can buy their property for 50 cents on the dollar and make that profit in the beginning. I never advocated for any of that type of stuff, because I always feel like it's taking advantage of people. Of course, on the apartment side, on our private equity company, we have no problem doing that to multi-millionaires. But I just always found it ethically wrong to go to somebody and buy their $100,000 house for 50 cents on the dollar, because they're just not savvy enough to call up a realtor and list it on the MLS. But so you won't hear any of those types of strategies. If you're here, you likely have money from your day job, and you're going to need at least $25,000 to $30,000 of liquidity to put down as a down payment. And since a lot of the loan to values that the banks will give you these days through a Fannie Freddie loan is going to be around 70% to buy the $100,000 house, that's how we backwards engineer, and that's how we get to that starter cash of $20,000, $30,000 roughly, with a little bit of leftover for cash reserves. Answering your question, do you have to be rich already? Not necessarily, but you definitely do need to have a little bit of investable assets, and you need to be credit worthy. Now, if you're starting out, we have a lot of younger investors who start out buying rental properties within our program. You may or may not have a couple years of work experience. Now, some lenders are able to work with your high starting pay and extend credit that way. What we would recommend is going through at least some of our initial starting content that we have, namely the remote investor ecourse, get educated, and then go and talk to a loan broker as soon as possible. There are tips in that ecourse on how to source the right one. One of the first things that I learned when I was investing was where do you invest and what types of investments to invest in. My first rental property that I bought in Seattle, Washington was, first of all, in the wrong area and the wrong type of investment. So I messed up those two. But you know what? Rental real estate is very forgiving asset class. You look around, you have a lot of people, to me, doing it the wrong way. They buy their own house to live in, and eventually they're millionaires by the time that they're able to retire. What we're trying to do is fine tune the strategy and optimize it so you can grow your net worth the quickest way and safest way as possible. So getting back to where do you invest? What we've decided is we want to invest in secondary markets these days. Now, what is a secondary market? It's not a primary market, and a primary market is a very sexy type of place that you probably want to live. So pretty much the whole state of California, Seattle, Hawaii, New York, Boston, Miami. These are the places where you're not going to have the rent to value ratios necessary to be able to cash flow. And again, I've said this before, a lot of this has to do with competition and crowdiness. You just have too much people with too much money trying to be amateur real estate investors out there. And that's something to be mindful of, right? Whenever you're around other unsophisticated, let's call it dumb money, right? You're probably on the side of a bubble. Like, one thing I personally see these days is a lot of people can't make long-term rentals work, which is what we primarily invest in. Yes, prices have gone up. It's gotten tougher. But where a lot of people have gone, a lot of the amateurs have gone into the short-term rental world. And that is something I'm just would not be very comfortable in it, because long-term rentals are catering towards the general population, right? The lower middle class, the glut of America, where this is why we invest in it, right? Because there's a great thesis in the rich aren't getting richer, the poor are getting poorer, and there's this divide, and the middle class, maybe that's you out there, is becoming pulled down to the lower middle class, and there's this higher need for this workforce type of housing, namely like the apartments that we own that rent from anywhere from $900 to $1,400 a month. good, stable value housing for the workforce of America, where short-term rentals cater towards people on vacation, which is a discretionary spending item. And in tough times, people stop going on vacations. So it's a very single point of failure. And that's the reason why I don't like short-term rentals. And I'm really bullish on long-term rentals, especially in the workforce housing sector. And that transitions into what class of properties we're buying. So there's different grades, A, B, and C class. So A class are your brand new builds, your luxury types of apartments or condos or houses. We try and stay away from this type of product because you're not going to find the rent to value ratios necessary to be able to remotely cash flow here. You're going to be competing with the most price insensitive people, and it's going to be really hard to find somebody to rent that thing. The only person who's crazy enough to rent that type of product is me, because I'm somebody who bucks the trend, zig when everybody's zagging, and I'm a big proponent to renting my own primary residence as opposed to buying it. But that's another story we'll get into later on down the road. But most of the people out there are needing to fall in this B or C category type of housing. There's no really rubric on what this is, but the best way I've discovered, just for education purposes, a C-class property is 1950s to 1970s types of assets. It's old, it's a little older, right? It's still got some serviceable life in it, but definitely old. And the B-class assets, which are somewhere between the 1970s and maybe now the 1990s types of product. Definitely not the new stuff, not the stuff that you probably want to live in, not the stuff you're going to show off to your friends, but stuff that majority of people in America, and especially in tough economic times, people downgrade into as they're looking to cut costs and go after more value types of housing arrangements. The other thing that we'll go into, what's probably come to mind is you've never owned rental real estate before. How do you manage the thing? And especially since you're going to be working with Class B and C tenants. And I'll be honest, they're a little bit difficult to handle. In some of our worst Class C properties, which we've tended to get away from these days, what we target in terms of acquisitions these days, we may have a property running at 80% collections, meaning 20% of people, or 1 out of 5 people, are just not paying. They're in deadbeat status. And that is normal if you came from that type of upbringing, which personally I wasn't, right? We weren't broke. We didn't live in mobile home parks. And I personally did not have the experience of operating these types of assets and dealing with these types of clientele, which is why I advocate all investors to use third-party professional property management. Not only does that allow you to have them be doing your dirty work and managing the tenants and collections and everything, but it also creates a bit of a buffer in terms of legality. They're the person dealing with the collections. They're the person getting documents signed by the tenants, and they're the ones taking the potential heat if anything should go wrong. Their job is to just get you the rent check. Of course, they're going to take sometimes maybe 10% of the income, but as far as I'm concerned as the investor, that's a necessary part of this business. And why I write about this in my book, a lot of new investors, especially those investors that invest in their backyard, say you have a rental property in Hawaii or California, likely the numbers aren't working. And you're somewhat trying to make those numbers work by self-managing it yourself. But what a lot of new investors don't realize is they're putting themselves under a huge burden in terms of legalities there, legal liability, and it's taking precious time, energy away from you. And this is what I tell a lot of my coaching clients is you got to focus on what is your highest and best use. If you're somebody who makes over $100,000, $200,000 a year, or certainly have a net worth of $1 million or greater, your hourly rate at your day job or managing your portfolio is likely going to be higher than you playing landlord and playing property manager boots in the ground. In fact, your job should be spending your time and energy going out there and making more money. And for a lot of our clients who have businesses or they're doctors, dentists, engineers, it's best time, their time is better spent at their day job, progressing that career field and trading time for money. Of course, their time is limited doing that when you start to get into the strategies that we talk about here. But getting that property management allows you to leverage your time. And at the end of the day, that's our end goal, which is to get out of trading time for dollars and build up a portfolio of assets. Now, what I discovered back in 2015 when I had 11 rental properties is these little rental properties just aren't scalable. They're great. Don't get me wrong, right? Like when I first started, I thought getting a few $100s of passive cash flow from each of these properties, and with 11 of them, that was about $3,000 of passive cash flow each month coming in. That was, as a single guy, that was like a third paycheck every single month. But let's be honest here, like what American family of four can survive off of $36,000 a year of passive cash flow? You're going to need, a lot of you guys say you need $10,000 to $20,000 of passive cash flow just to start thinking about maybe you or your spouse quitting their day job. And therefore, you're going to need to increase the number of properties by 3 or 4-fold. Instead of 11 properties, I maybe needed 30, 40 of them. And let me tell you what it's like to own 11 rental properties. Even if you have professional property management doing your dirty work for you, I had maybe an eviction or two every year, and some kind of big catastrophe, like a tree falling on the house, some minor flood in the basement on one of them. Something like this happened every other month. Now multiply that exception rate by 4, and you're quickly realizing how inefficient and this becomes a second job to you. And then you start to realize, sure, the equity is getting built up, right? Because the tenant's paying down my mortgage. How inefficient it is to sell the assets or do cash out refinance to re-leverage the asset into more properties. And that in turn is one of the biggest mistakes I see investors make, is they don't effectively move their return on equity around, or they don't effectively move their equity around. This is a concept that I call return on equity. I have a great article on it at thewealthelevator.com/ROE for any investors out there who've owned rental properties for more than a couple of years. Definitely need to read that and understand that concept. But this is where it's very difficult if you own tangible, real rental properties one by one. And when you start to see and get into the content of the syndication investments, being an LP partner, you start to see how these holdings naturally phase out, and then you go into another one. And now instead of you dealing with day-to-day problems on the property, managing the manager, you're more in the role of a fund manager, your own fund, in fact. So don't get me wrong. Single family homes, great for people getting started, but you definitely scale out of it. And that's the kind of the whole purpose between the wealth elevator and cutting the timelines, compressing these cycles so that you don't have to be like me and waste your time and get 11 rental properties, and then you have to spend all this time to sell them and going into the next level. We can somehow have you cut these steps and cut time off of the timeline to get to where you want to be, which is on those higher floors of the wealth elevator.